All right. What is going on, Discord and YouTube family? And welcome back to another edition of Top Down Analysis with me, T. Hobbs. As per usual, we will be going over the S&P 500, the NASDAQ, and the E-mini Dow Jones for the week. Before we get started, please make sure you tip the barber, aka hit the like and subscribe button, or you can, drop a thumbs down. It's fine. Just if you're enjoying this information, leave a comment down below. Let me know how you're feeling about it. Now, going into last week, we talked about the market continuing its bullish, aggressive push to get to all-time highs. Let me be frank and clear right now before I go over any of the news. I still am 100% bullish on this market. I know a lot of people, you'll see a lot of YouTube videos and you see a lot of people talking about, World War III and all that good stuff. Let me explain something to you guys. I've been in this market long enough to know that we only go really one direction, number one. Number two, war is actually bullish for the market. It may take a second, the volatility, the market has to absorb everything that's happening, but ultimately we're going to continue to go up, right? Like, will there be extreme volatility on Monday? I'm expecting extreme volatility. Am I expecting downside? Absolutely. But overall, when we look at the monthly, we look at the 3-month, we look at the weekly, what am I anticipating? I'm anticipating this being a pullback so that we can go higher. So a lot of my analysis is going to reference just that. So that being said, let's start right over here to the S&P 500. We'll take a look at the 3-month chart just briefly. And again, I'll just reiterate what I've been saying this entire time, which is if you look at the 3-month chart, which is the last 3 months of price action, look at the body. Look at the body here, look at the wick here, look at what's happening at the highs. Yeah, even if we drop down to the, nitty gritty of this candle, it's fine. Bulls are still in control. Like, they're still in control. Over a 3-month period, they built more support than the bears have. That's just the reality. That's the objective truth, right? Dropping down to the monthly time frame, more support for that thesis. We had our drop here in April, fought that back up. Since then, we've been making higher lows and higher highs, even with this candle that's going to drop a little bit on Monday morning or Sunday night. It's going to drop down some, but ultimately what's truly happening, as long as we stay above 58, 71, 75, and really as long as we stay above 5,600, this is still bullish, right? The market is still remaining very, very much bullish, right? You can even support 57.71 and still be extremely bullish on the monthly time frame. Higher time frames are ruling this show. Everything else is just for show, right? That's really all it is. There is no sign of bears on the monthly time frame. There's no sign of bears on the 3-month time frame. Let's drop down to the weekly and see if we can find them, okay? Looking at the weekly time frame, of course we're going to be bearish here. We're at the all-time high. We did break structural lows here, and here, right? Only to rally back up. But remember, we left gaps. We left gaps at 57.51 on the S&P 500. I believe there's another gap here, and we'll talk about that when we get to the daily time frame. And that's what I believe that the market is going to start to push toward. We have a huge catalyst that's in the market right now in regards to fundamentals, and that is that America just bombed Iran. You know what I mean? And that's going to cause a little bit of fear to creep up into the markets. Fear at the highs is perfectly normal, right? I'm anticipating a pullback, right? I'm anticipating the market pulling all the way back. You never know how the market is going to be delivered. So if you look at my previous videos, you'll say, well, you were just a bull up here. Of course I'm a bull up here until the bears show me their teeth. Over the weekend, we got new information. The market is ever changing, and new information lets me know that, hey, fear just got pumped into this market. The market has gapped down on some of these overnight indices. So you can look at some of these overnight sessions, not overnight sessions, but like other brokers like IG. And you can see we gapped down, or we're starting to push down, and we're already all the way down to 59.74 at this particular broker in the overnight session. So what does that tell me in relationship to the market? If I look at 59.74, then that really is just, somewhat of a pullback, but not really an aggressive pullback. When we go down to the daily and 4-hour time frame, you'll see exactly what I mean when I say it's not really an aggressive pullback. 59.74 is way up here, right? Like it's basically the bottom of the previous week's candle. So let's see if we can break that week candle and then start to push back into the 57.69s, maybe even as low as 55.05. We'll see as far as how low they want to bring it. But that's what I'm anticipating over the next few weeks, even maybe in the next couple of months, because we do have major catalysts coming up, but we have a little gap before those catalysts hit. And those catalysts that I'm referring to is the tech sector earnings in the next 30 to 60 days. So let's drop down to the daily time frame, get a little bit closer to price, and we'll understand if we kind of stretch these out and get a good look at what the daily has been up to. Well, let's just overall analyze what side of the curve we're on. From this level here, right, on April 10th, we rallied up. On April 22nd, we made a higher low, and then we gapped up on the 23rd. This is why I said on the higher time frames, we could even come all the way back down to this gap at the 5300s, which I would welcome that pullback with open arms. However, we continue to rally. We made a new high above that April 10th high, and then we got above the swing high, which turned us extremely bullish. 58.36 is what we call the swing high. That's what this area right here represents. This entire range will be retested. Why? Because anytime the market breaks a high, it consolidates. If it doesn't break another high, it consolidates, and then it goes back to where the buyers are. The buyers are here. So between 58.45 and roughly about 57.14, you can anticipate a pullback and us clearing up this gap right here. If we get extremely bearish, i.e. oil continues to rally, gold continues to rally, the bond market starts to rally, then I'm anticipating a pullback all the way back down to 53.79, but this pullback is going to take us some time to get there. I'm anticipating the market doing the same thing it always does, drop back down in the summer months. It took a little while. I was anticipating May being the time that we would drop, but usually we end up dropping around the summer months, nice and choppy. We enter into, a little bit of extreme fear. Everybody gets scared. And then we get to these lows, fill this gap, and then boom, the bull market starts right back up again. So far, this looks like the start of what could be something like that, especially with a fear-mongering catalyst such as potential World War III, right? Let's drop down to the 4-hour chart, and then I'll break down my levels in regards to where I'm looking to trade the market, where I'm looking for the market to go on the week on the S&P 500. The first thing that I wanted to mention was, hey, I don't draw patterns all the time, but when they just keep being so prevalent like this one is, I gotta at least point it out. The fact that we've been in this rising wedge pattern since May 11th of 2025 is crazy. But if you just draw a line on the daily, I think is where I got this trend line from the highs and the lows, we've just been sitting inside of this range, right? A rising wedge is basically a tight range as we go back up to the highs, right? What I would be looking for if I'm a bear is I want to see the market break through this structural low, and that low sits at about 59.74, which is exactly where the overnight pricing is right now, right? If we can get below this and start to trade below 59.69, give or take last week's low, then I'm anticipating a run on these lows, right? A run on these lows means that what I'm looking for is I'm looking for the market to run liquidity here, 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 and potentially here, getting back down to this level and closing the gap or the new week opening gap from May 11th. When we get here, I'm not looking for a full-on reversal. I'm looking for a pullback to start that downtrend, and then we go lower. That I will reiterate on later videos, depending on what that pullback looks like moving forward. Now, as far as my levels for the week, let's look at the 4-hour time frame, like I just aforementioned. What we'll be looking at, if you want to be a bear or a bull, you want to see the market trade down. Like, that's just as simple as that. We already know that overnight we're gonna get a gap down. Like, the volatility alone is enough to spook the market and push us down. Like, I would be very shocked if we didn't get a gap down, put it that way, unless our president comes out and says something that is purposely meant to boost the markets. I just don't see us gapping up. I see us gapping down. So from those levels, I'm looking for the chessboard high, pushing back down from the close at 60.28, coming down about 3.80%, pushing us down to 57.99 to end the week bearish. From the gap or the previous day low, right? like I said before, 59.74 is where the projected gap is. But that would just mean I would be taking my measurement from the previous day low and below. Previous day low from 59.69 down about 3.85%, puts us right at the previous, right at the NWOG at 57.40, 3.85%, which is exactly what I'm talking about on the higher time frame. Closing this gap makes sense this week because it would fit with the data or the true range of 3.85%. So that's what I'm looking at to the bear side. To the bullish side, I'm looking for the same thing theoretically, just delivered a different way. So if we want to be bullish on the week, I also want to see us trade down. What do we trade down to? Well, we have this nice little 4-hour demand that was built inside of this rising wedge. So it's not truly a demand zone, but we are breaking structural highs and we left behind a gap. So I like it to the upside from this level. Therefore, I'm looking for price to push up from 58.43.75, 4-hour demand zone, 3.80% into 60665 or 6625, essentially going right back up to where we started the week, right? Same thing if we drop down inside of this 4-hour demand zone at roughly 58.26. I'm looking for, again, 3.80%, pushing us back up to 60.4750. Now, mostly I'm leaning toward the bearish side. I just want to see how the market reacts to the gap that we put in. If the market starts to respect that gap, meaning if we open and we're below 59.74 and we don't fill that gap and we start to trade away from that gap, it would be a very unwise decision to start trying to long the market much higher than that gap. Because essentially what they're saying is, hey, we don't want to buy above 59.74. So just be aware of that as we open with this potential NWOG that we're coming up with, because a lot of people that are on the bullish side, they're going to be trying to long this back up into the 6,000s. But think about why the market gapped down. And if it gapped down to put people in pain, why then would it give those people an opportunity to get out? Just food for thought. So those are my thoughts on the S&P 500. Let's break down the next instrument, and I believe coming up is the NASDAQ, which is what most people trade. So looking over here on the NASDAQ on the 1-month time frame, again, we'll start with the 3-month because I really like looking at the bird's eye view. First of all, in the 3-month, we have 8 days and 4 hours remaining in this 3-month candle. And ask yourself, just really, really objectively ask yourself, in your opinion, do you think in order for this market to turn bearish, right? Let's just put some statistics out there on the NASDAQ. In order for this 3-month candle to really turn bearish, it has to break even, it's got to fall 25%, 26% in 8 days and 4 hours. Do you think it's a higher probability that we fall 26% or that we hold this candle and it still remains green? I'm going to lean on the side that we probably aren't going to fall 26% in 8 days. Therefore, I can deduce that this 3-month candle is most likely going to finish bullish in favor of the bulls. If that's the case, then I'm anticipating the next 3 months to also be in favor of the bulls, maybe with a pullback inside of that previous 3-month candle, but still favoring the bulls nonetheless. Okay. On the monthly time frame, same thesis here. The monthly and the 3-month are closing at the same time. Okay. 8 days and 4 hours. Higher lows, and higher highs. Undebatable. So which one's more probable that we finish this month bearish? And this could happen. I won't say that this can't happen. I mean, this is, roughly about maybe 700 points. The market could definitely finish this month bearish. But the question is, what does it do next, right? Which one is more probable, that we sell all the way back down here, or that we maybe tap into roughly about 50% of May's candle, right? The monthly fib on May, and then start to rally higher. I'm going to lean on the side of the bulls because it's just it hasn't been fun trying to be a bear in this market. If you've been trading this market for the last 2 or 3 years, you understand exactly what I'm talking about. Moving down to the weekly time frame, we look at the bearish signals at the highs. Yes, we are getting bearish signals. We're at the high, as we should. We have a catalyst to push us back down to the lows. But the question is, what is your low? What is your targets? Well, I would point out this high right here. As the market did take out this high, this is the dealing range previous. So those levels sit between 20,551 and 19,559. There's a huge gap right there that the market should be looking to target. And remember, we have intermediate lows here on the weekly, here, and here. All of these are liquidity levels that the market is going to be looking to run. If we take a Fibonacci retracement and we take it from this high, which was the previous high, and we take it from this low, which is the previous low, where does that take us? Well, 50% sits at 19,442, which is damn near exact of this level. And then 68% is probably going to sit right at this 20,000 level, 70% at the highs and 30% down here, which I'm going to leave this here because I'm going to venture to say that that other gap that we see on the daily and the 4 hour is probably somewhere around this lower 30 percentile level right here. It just depends on how bearish this market truly wants to be and how low we got to go to find more buyers. Ultimately, what I'm saying is I'm bearish to start the week. I'm bearish basically for the whole week. However, I understand that after we run all of these lows, it's time to probably get long right at around maybe Thursday. I don't know. Call me crazy. Anyway, moving down to the daily time frame, 21,874 is where we close. But again, we started the descend. We had the rally, we had the basing candle, we had a drop candle, and then more doji candle craziness. But now we're getting a gap down. We know we're getting a gap down. And I believe that the US Tech 100, which is the NASDAQ over on the CFD side, is at 21,363. Let me refresh this screen just to make sure. Sometimes this thing won't refresh. I mean, unless you actually hit it. But yeah, kind of estimate where that is. It's not going to be 100% accurate, but because it's based off a certain broker, it's not based off the global economy. But let's go back to the charts and see exactly where that is, right? We're looking at the daily time frame. Looks like we're loading a little bit here. Hang on. There we go. All right, we're looking at the daily time frame. We can see 363 is roughly this low right here, right? Like basically this low on June 3rd, right? So if we're gapping all the way down there, we've already started to take out liquidity lows. That means we've taken out this low, and this low. What's left? This low at 21,402, and then this low here at 20,737. You see how the gap down can assist with running that liquidity so that, you know, retail can't participate, but then retail will be left chasing the bag, right? So once we run these lows, I'm anticipating a push back into this gap fill here. And again, if we get really bearish, you can see that that other level, that 30% range that I was talking about, is right down at this gap fill here. So again, if my overall thesis to the bearish side is to be true, I'm anticipating the market pushing all the way back down here by roughly about October timeframe. Let's move on down to the 4 hour time frame, and then I'll break down exactly where my levels are on the week. And then we'll get you guys on to the next instrument. All right, so bringing out the levels for the 4 hour time frame on the NASDAQ. Let's see where we are. All right, so again, like I said before, either way it goes, if you want to be a bull or if you want to be a bear, the market's got to trade down first, no matter what. So if we're trading down bearish, where are we coming from? We're coming from this close, which is roughly about the chessboard high. And we're coming down about 3.98%. Again, this is the average true range. It's not going to take in consideration volatility of the current market right now, because the volatility increases, the range is going to increase, but we don't have that data yet. I'm basing this off the last 7 weeks of data. So that's what my levels are based on. All right. Chessboard high, 21,891, which is right here. I'm looking for about 3.98%, pushing us roughly to 21,038. Things to note on this week. Monthly fib needs to be retested. Usually we break above the month. The previous month's 50% becomes a target for this month. 20,765 you need to mark, or 20,760.25. You should definitely mark that level in your chart. Once we get down here, however, there is a 4 hour demand zone at 20,563, which brings us to our weekly projection of 20,543.50 from 3.98%. And that is going to be my bearish projection on the week. My bullish projection, we get down here and then we get a bounce. My bullish projection is going to start from 20,563, We push down here on a Tuesday. I'm looking for a rally back up about 4.15% to 21,412. And if we can't even come down this low, then like I said, monthly fib would be a key level. I'm looking for a 4.11% move back to the upside of 21,606. Again, it's all going to depend on how the market is delivered, how much volatility is truly going to be pumped into this market. But for the NASDAQ, those are my thoughts. Those are my levels on the NASDAQ. Moving on to the next instrument, which is the Dow Jones. Now, for the Dow Jones, unlike the other instruments, on the 3-month, it looks kind of suspect. I'm not going to lie. It's still bullish, right? But there's not as much body, meaning there's not as much buying going on the Dow as there is on the NASDAQ and the S&P. Now, I like to say that the NASDAQ tells the truth more so than the S&P the Dow Jones tells the truth more so than the S&P and the NASDAQ. The reason why I say that is because there's less stocks in the Dow Jones, so it's going to be a little bit more truthful with its price action. That being said, I'm still leaning toward the bullish side, not to start the week, but heading back into the previous month's candle to start that bullish ascend back to the upside. We look at the monthly candle and we see that on the monthly time frame, we are getting that higher low. We still made a higher high. This candle, although it was faint, we still got above the previous month's high and still making a higher low. The buying in isn't as strong. It could just take a little longer to get it up here because it's less stocks, it's less strength to get it up here, right? So ultimately the direction, however, is still in favor of the bulls. Let's move on down to the weekly time frame and we can see again this level. Here, let me get my little rectangle here. This level right here is important, right? And you can see the Dow Jones, unlike the other two, is sitting right inside of that level still. And like I told you guys, the NASDAQ and the ES would lead the pack. The Dow appears to be, just taking its sweet time, pushing back up here. However, all of them are still at roughly about the same level. However, as the NASDAQ and ES are pushing up to the all-time highs, the Dow Jones is kind of stalling out at the supply zone on the weekly time frame, which is here. And then I'm anticipating the same retracement. But when the Dow Jones finally builds the strength, it's going to be the instrument to watch, in my opinion. I'll definitely be watching it very, very closely because the Dow Jones has really underperformed this year thus far. And I don't think it's going to stay like that all year. So when it does start to perform, I want to be in those trades. And I think it's really going to make a strong push back to the upside. And the percentage gain on it is going to be much higher than that of the NASDAQ or the S&P. If we take our Fibonacci retracement, we take it from the previous high down to the previous low, we can see that retracement is going to bring us back to, you guessed it, those gap fills. 50% sits at the gap fill here. 30% when we come back down to the daily, you'll see that it's going to sit into this same gap fill. 70%, obviously we need to get above this high, right? Which we just barely did, right? Which is good, right? That's telling me that, hey, we still finding buyers up here. But ultimately, I'm looking for pullbacks back into 40,948 and potentially 30,244, which again would take a lot longer than just this week. We look at the daily time frame and to reiterate that gap fill right here at April 22nd, the market should be looking to pull back here. Ultimately, how it gets back here, I don't know. How fast it happens, whether we gap down, I don't know that. But I do know that this gap needs to be filled and the market will fill it at some point. For now, I'm leaning toward the bearish side, and let's go through the 4-hour time frame so I can break down the levels moving into this week. All right, going over to the 4-hour time frame, let's bring out the top-down analysis for this week, and we'll get you guys out of here after we go over a little news and volatility index information. All right, moving over to the 4-hour time frame, we can see the chessboard high is where I'm looking for price to come from. That level sits at 42,580. I'm looking for about 3.53% to the downside if I want to be a bear this week, which puts me almost right down to the monthly settlement at 40,767, but it puts me at 41,770 from the chessboard low, because we know we're going to gap down. I'm assuming, if I'm a betting man, if we gap down, it's probably going to be right inside of this 4-hour fair value gap, but I'm going to still stick to the way that I break down price. So chessboard low, what am I looking for? 42,406, 3.53% at 40,905 for the end of the week. If we're going to be bullish, there's a couple levels where I want to see the market hold. We can still trade down. And like I said, I think the gap should be inside of this fair value gap somewhere. 42,205 to be exact. I'd be looking for about 3.6% back to the upside, looking at a total of 43,730 of 3.6% from this 4-hour fair value gap. All right. If we trade down lower, I'm anticipating us pushing back down to not only the monthly fib, but the monthly fib also lines up on the Dow Jones with the 4-hour demand zone. So we have a 4-hour demand. As you can see, we have this low, took out this high, which equals a demand zone. And it left behind a nice, pretty 4-hour fair value gap. So I really like when we get that triple confluence right there. So the 4-hour demand zone lines up with the monthly fib. I'd be looking for the price to push from here back up to 43,411 for about a 3.67% move on our weekly projection going into this week. Again, there are a ton of catalysts that are already in the market, but for the purpose of this video, we're just going to be discussing things that are on the calendar headed into next week, and there's a ton of those too. So moving over to the news for the week. Sunday, obviously, there's really nothing much going on in the market for the New York session, but kicking the week off, we have red folder news, flash services PMI, in addition to the fact that we're potentially at war right now. We also have red folder news at 9:45. We have a ton of FOMC speakers that will be speaking. I'm sure they'll be referencing the war, maybe the rise on oil prices, all that stuff, and how it's going to affect inflation. If you're a fundamentals guy, definitely want to pay attention to this week. On Tuesday, the big dogs should be testifying in the Senate. This is going to be a big deal on the first day because the market will react to this on the first day. I don't know how many top-down analysis I've done, but I can tell you from experience, the first day, the market will react to Fed Jerome Powell speaking. We usually get a lot of consolidation and a bunch of crazy movement, all that good stuff, because he starts speaking right inside of the market open. On that day, I may just fade the New York session and trade the PM session, or make sure I'm up for the London session, because I really don't even want to be involved inside of the New York AM when the Fed chair is speaking, right? So I pass on that altogether, but it's definitely newsworthy. On Wednesday, his second day, the market will most likely move normal. From my experience, I've done this for about 3, maybe 4 years now. In my experience, the second day when he's talking in the House, the market does not care. It usually moves normally, but it still is relevant for red folder news. All right. Going into Thursday, we have our usual unemployment claims to get the market maybe in a reversal pattern. Usually Thursday brings in a nice little reversal. People like to take profit on Thursday and start to pile in for Friday, because Friday, again, red folder news, we have core PCE price index. Now, this is going to be important because this is the one that the Fed pays attention to the most. Now, although I don't see the Fed raising rates or dropping rates anytime soon, he's still going to continue to pay attention to the data. So if the data gives us something significant, I'm sure the structure will tell us before the data hits, but at the same time, the data will be the final hoorah, so to speak. It will be the final catalyst that pushes us in the right direction. All right. That's the news for the week. Now let's move over to the volatility index, and then I'll get you guys out here. Now, the volatility index, I've been saying it, and I'll say it again. The VIX does not like to trade at all-time lows. Anytime it gets down here, you can anticipate a rally. We got the rally. We got the gap up on the new contract. We traded back down and closed the gap on the new contract. And now we're just kind of in this range period. Now, because of the news that was introduced on Friday or Saturday about the strikes on Iran, where am I anticipating the VIX opening up? I'm anticipating the VIX going back up to these 28s to retest these lows or these highs that brought these potential lows on the weekly. If we can do our job, we should be trading above the 40s. The VIX needs to trade above 41.5 for any continuation to the bearish side to commence. If we cannot trade above the 41s, 45s, then the market will range inside of this dealing range of the VIX, right? That's basically the only thing you really need to know. I mean, we can look at the monthly and all of that good stuff, but I'm telling you, the VIX either needs to get out of this range of 41.33, or it's going to just continue to remain in this range and bounce and play games, right? So any significant movements of the VIX are going to come when we break the high, not the low, because the low is going to be in the 14s or 15s. And I'm telling you, the VIX is not going to trade lower than that. I guarantee it, right? But the goal is to get the VIX to push higher. So the fear needs to be pumped into the market. So I'm kind of, no, I don't want to sound insensitive. I'm excited for the volatility. I'm not excited for us going to war, because I know people lose their lives in war, but I'm just talking from a financial standpoint, right? So that being said, guys, that's all I got for this episode of Top Down Analysis. Again, if you like what you see, please make sure you tip the barbers. My name is T. Hobbs. This is the Trader Shop, and I'll catch you guys on the next one, man. Peace.